Good evening, students. Can you hear me?
Yes, madam.
Okay. So we can start. Last week we did business income. So that is the second income source. So today we are going to start from the not the business income but the deductions. So why do we need deductions? That is very important. Deduction rules are very important. What is the reason? Why deduction rules are very important? Because I think you can remember the format of the calculation. So it is like this. So during the last few sessions we did employment income. So at that time we considered what are the income we have to include, then what are the income we have to exclude, and at that time I explained that there are no deductions available for the employment income. That means we cannot deduct any item, any expenditure when we are calculating the assessable income from employment. So we did that calculation up to assessable income. So after that, in our journey to the computation of tax payable amount, we have to pass several stages. So first one is the assessable calculation of the assessable income. So we did it for the employment source. Then we started to calculate business income source. Then I explained what are the item we have to include under business source. Then what are the items we have to exclude under business source. So business source we could exclude some items. Mainly we had some exemptions. Then now I am going to explain the deduction rules. Deduction rules means for the business income and for the investment income, there are some expenses that can be deducted when we are calculating the assessable income from business and assessable income from investment. So you should know what are the allowable expenditure for the calculation of assessable income from business and investment. So that is why we are going to study deduction rules. So these deduction rules are available in the Act. It has given under several sections. So in the deduction section, it says deduction will be discussed relevant to business income and investment income. And these deductions are given in specific sections, under specific sections. So general deduction rule is available under section 10. Then main deduction rule is available under section 11. Then specific deduction rules are there, those are from section 12 to section 19. So all these sections we should know how to apply for the calculation of business income or investment income. So under section 10 you can see general deduction rules. So prior to that, I like to show you the way it available. It has included in the Act. So now I am moving to the Consolidated Act. Yes, now we are in the Consolidated Act. So now we are in the Consolidated Act. So this is how it shows the deduction provision. It is in under 4 divisions. We say the title as deductions. Then section 10 is there. and subsection 1. Subsection 1 has several sub paragraphs A, B, like that. Then items also there. So the marginal note also provided, that is general deduction. So under general deduction, mainly it says the items that are not deductible. Please wait a moment. I think the internet connection is stable. Okay, so mainly general deduction rule says the expenditure that are not allowable as a deduction. That means if we identify the items that are not available for the deduction, then for us it is very easy, because then we know what are the items that can be deducted as an allowable expenditure. So section 10 subsection 1 paragraph A says no deduction shall be made in calculating person's income from employment. So now I know why I told you that it is not available for the employment, because it says under section 10. Section 10 deductions are allowable for the calculation of an employment income. Then under paragraph B it says the following deductions shall not be made in calculating person's income. So here you can see the term person, not the individual, because these deduction rules are available not only for the individuals but for the person. So for a person, those are these expenses are allowable, not allowable for a person. That means not only for the individuals but for the person. So not only for the individuals plus entities. These deductions are applicable. These non-deductible expenses are applicable for all all individuals, all entities. That means for the persons. So likewise, you can see the deduction rules in the Act also. So I have summarized those deduction rules in my slides. So if you need further clarification regarding that deduction rule, please go to the Act, not to the presentation slide. This is just to know that you have this kind of deduction rules, but for the calculation definitely you have to apply the wordings in the Act. So under this is section 10, section 10 subsection 1 A and B. So I explained about A. Then subsection B says some deductions are not allowable. So under section 10, the deductions that are not allowable has mentioned. So it says some deductions are not allowable in calculating a person's income. So it is mentioned under section 10(1)(b). So that means section 10(1)(b) says the items that are not allowable as a deduction. Oh, you have DAK asked a question that is very question I have explained it in our first session, so I think you were absent on that day, because I explained the difference between the person and the individual. So in the Act, we have a definition section in section 195. In that section, there is a definition for the person. So in the Act, person means not only an individual plus entity. So if you need further clarification, I will explain it at the end of this session, because all other students are in this session. I think they know about this, the difference between the person and the individual. So what are the items mentioned under 10(1)(b)? I will explain it later, because it is very lengthy provision. Yes, it is here. So section 10(1)(b). Section 10(1)(b) says the items that are not allowable as a deduction. So we can say it like this. First one is domestic expenses. So domestic expenses are not allowable as a deduction. For the term domestic expenditure, we have a specific definition under section 197, not under section 195. But section 197, if you can refer that section 197 now, you can see what are the domestic expenditure. The next one is, I will explain it later, because it has several subcategories. Then the next one is tax payable under this Act. So what are the taxes we have to pay under this Act? What are the taxes? Mainly income tax, then capital gain tax, if you are considering withholding tax, if you are considering APIT. So all taxes are paid under this Act. So those taxes are not allowable as a deduction. Then third one is interest, penalties and fines. That means we are paying that kind of expenses if we breach of any written law. So that kind of expenses are not allowable as a deduction: interest, penalties and fines. Then I have mentioned what are the domestic expenses here. So what are the domestic expenses? So prior to that, I like to explain the other expenses, because this section 10(1)(b) is very lengthy one. So if we can refer it in the Act, it is easy, because domestic expenses are given in separate place. But I like to explain it in the way it has applicable, so that is why I included domestic expenses here. But I like to explain it now according to the Act. So that is why I am explaining now this section, item 4 here. So item 4 says expenditure or any other deduction to the extent incurred by a person in deriving exempt amounts of final withholding payments. That means, I think you can remember, when we are considering the income here, what we have done, we identified all income here. Then we removed, when we deducted excluded items. In that excluded items, exempt amounts also included. Under Schedule 3, you can deduct excluded exempt items. So that means the balance is the liable income. Total income minus excluded items and exempt amounts. That means the balance is the liable income. So we are going to deduct expenditure that are entitled for the liable income, because that exempt income is not included in this balance income. So that is why we have to remove expenses incurred for the exempt amount. So I think you can understand what I am explaining. Since we are considering only the liable income here, we can deduct expenses that are relevant for the liable income. So that is why we are removing expenditure or any deductions to the extent incurred by a person in deriving exempt amounts of final withholding payment. So now I think you can understand why we are removing expenses incurred for deriving exempt amounts. So it is not a eligible expenditure for the deduction. Then the next one is retirement contributions. If we are going to deduct retirement contributions, unless they are included in calculating the income of an employee or consist of a contribution by the employer to a pension, provident or any other fund approved by the Commissioner General. That means if that retirement contributions are not considered for the calculation of employee, that kind of expenses are not allowable in the hands of the employer. So calculation of business income is, we should be considered it in the hands of the employer. So we have a lot of employees in our organization. If that employee is not considered his retirement contributions in his income tax calculation, so the employer is not entitled for the deduction that similar expenditure. The next one is dividend of a company. So if you are working in a company, you know that after calculation of their profit, net profit, then after calculation of the profit, they can distribute dividends. So that dividends also in the one of the deductions of a company in the company's hands, but it is not deductible when we are calculating the business income. That means for the taxation, dividend distributions are not allowable as a deduction. The next one is outlays or expenses for entertainment. So the term in red color has a specific definition. That is why I have specifically mentioned it. So for the dividends, we have a specific definition. So it is in section 195. So for the term entertainment also, we have a specific definition under section 195. It says what are the expenses we are consider as an entertainment expenses. So that kind of expenses are not allowable as a deduction. So after I am moving to the consolidated debt, I will show you the definitions. So the next one is an amount that a person has transferred in his financial accounts to a reserve or provision for expenditures or losses not yet incurred but expected to be incurred. That means, what is the meaning of that? When we are calculating company or an institution's profit, that I mean book profit, not the taxable profit, at that time we are deducting some amounts that we are transferred to the provisions, some to the reserves. So those are allowable. For an example, bad debts, then depreciation. So that kind of things are allowable when we are calculating book profit. That for the but for the taxation, we do not allow that kind of provision. So transfer of provisions transfers to the provision or to a reserve. The next one is amounts incurred on lotteries, betting or gambling other than amounts incurred from deducting a business of lotteries, betting or gambling. That means, so I think you can remember in the source, when I am explaining about 4 sources, I told you that the lotteries, winning from lotteries, betting or gambling also a part of the income, that is investment income. So if we consider that kind of investment, that kind of income under investment income source, the deductions are not allowable. So what are the deductions? If we won a lottery, what kind of deductions we can, what are the deductions we can consider? Then the deduction can be a lottery purchasing amount. So, but that kind of expenses are not allowable as a deduction. That is what it says. If we have an income like lotteries, betting or gambling, that means a winning of lottery, winning from betting or gambling. So deductions are not allowable. But if I am doing a business of lotteries, betting or gambling, for that business we can deduct expenses. So if we are considering winning from lottery, betting or gambling as under my investment source, no expenses are allowable. Then item 10, it says taxes or other levies specified by the Commissioner General. So these taxes and other levies are specified. What is the meaning of specified? Specified means definitely we have to issue a gazette notification. Specifying by the Commissioner General means Commissioner General should issue a gazette notification for that item. So for this item we have already issued a gazette notification. In that gazette notification we have mentioned what are the taxes or levies that are not allowable as a deduction. So in this section, in section 10, it says the taxes that are deductible under this act also not allowable as a deduction. As well, other taxes and levies are specified under item 10. So all these taxes or levies are not allowable as a deduction. So we have a specific gazette notification for that. In that gazette notification it says value added tax. There are a lot of taxes, mainly value added tax. It is applicable students like you. So value added tax is not allowable as a deduction, but SSCL it is allowable as a deduction. Then the next one, a deduction for a payment shall not be allowed until the tax withheld has been paid to the Commissioner General. So this is also a very important one. The Commissioner General has mentioned what are the mandatory deductions by the withholding agent. Who is the withholding agent and what is the withholding? Withholding means when a person making payment to other party, when they are making the payment, Commissioner General has specifically mentioned in the Act to deduct tax on that payment, and the deducted amount should be paid to the Commissioner General of Inland Revenue. So we call it withholding tax. The person who should deduct that tax is named as withholding agent. So if this person is a withholding agent, and if that person is making a payment to another person, to be deducted that payment as eligible deduction, the person should deduct withholding tax and should pay to the department. If not, deducted that withholding amount, this person is not entitled for the deduction of that total payment, not only the withheld part but the total expenditure. For an example, if I am engaging in a business and I have rented out a building for that business, so I have to pay rent expenditure for the tenant. When I am paying rent payment to the tenant, what I have to do? If that payment is more than 100,000 per month, I have to deduct 10% as a withholding tax. If I have not deducted that 10% and not paid to the department, I am not entitled for the deduction of total rent expenditure I paid to the tenant. So this is very important provision. Through this provision, we can collect taxes very easily, because when we are making the payment to another party, we have to deduct taxes on behalf of that tenant. So tenant can collect that, consider that amount as a tax credit, but until then the commissioner, they have to make that payment to the Commissioner General. The next important one is, no deduction shall be allowed except as expressly permitted by the Act. So if that Act says specifically that this kind of taxes are not allowable and this is allowable as a deduction, that kind of expenses can be deducted. The next one, if for the deduction of one expenditure, if several rules are applicable in that, then we have to apply most applicable specific deduction rule. That means in this section, I think you can remember, I have mentioned these sections. So section 1 is for the general deduction, section 11 is for the main deduction rule. Specific deduction rules are from section 12 to 19. So if we are considering section 11, 12 to 19 sections, if one expenditure, when we are making an expenditure, for that expenditure, if more than one deduction rules are applicable, then the most specific deduction rule should be applied for the deduction of that expenditure. Then this is a new amendment, that means last amendment, included in the last amendment. So no deductions shall be allowed to a person in computing his income. That means if person is making a payment exceeding 500,000, at that time, if that person made that payment in cash, that is not allowable as a deduction. That means if we are making a payment of the value exceeds 500,000, then we have to make that payment through a bank. That means it can be either credit card, debit card, electronic payment system, through a bank account. So we have to make that payment through a bank account. Why we have included this kind of amendment? We have included this kind of amendment to avoid cash payments. If payments are making in cash, that kind of cash payments cannot be traced by the Commissioner General. So therefore we have included this kind of amendment. That means if we are making a payment exceeding rupees 500,000, that amount should be paid through a bank. So this provision is not applicable to the government or financial institutions. So bank account means normal bank account, government institution means government department, like that. Single transaction means the purchase or procurement of any goods or service on a single invoice. So it is mentioned because the 500,000 can be considered, can be in several transactions. So that 500,000 should be in one single transaction. If they are making more than rupees, exceeding rupees 500,000 in one single transaction, it should not be in cash, it should be in bank transfer, through bank. Okay, so these are the main provisions available in section 10. So now I want to go to the domestic expenses. So I think now you can understand what are the amounts that are not allowable as a deduction. In these deduction rules, I have mentioned domestic expenses. So now I am moving to that definition. So I think you can understand here. Section 10(1)(b) says domestic expenses. It has a definition in section 197. So now we are moving to that section 197. So I think you can remember. Please keep this deduction rule in your mind, because this is very important when you are calculating an assessable income from the business or investment. You should know what are the expenses that are not allowable as a deduction, because as I have given you some examples for the employment income, I will give you an example for the business income also. In that example, I will give you several expenses that the institution has already deducted. So you should identify what are the expenses that are allowable as a deduction and the expenses that are not allowable as a deduction. If you have identified some expenses that are not allowable as a deduction, but the institution has already deducted, then what we have to do? We are not allowing that kind of deduction, so we have to add that deduction amount to the profit to calculate the taxable profit. Taxable profit means assessable income from the business. So for that purpose, you should know what are the items that you can deduct and what are the expenses that you cannot deduct. Okay. Now I am going to explain about the domestic expenses. So it is mentioned in the separate section, that is in section 197. So this section 197, it explains in 3 sub paragraphs. So this is paragraph 1, section 197, subsection 1. Section 197, subsection 1. It says, individual incurs expenditure in respect of himself. So these domestic expenses means expenses that are not allowable as a deduction. So this domestic expenses has 3 categories. Category 1 is individual incurs expenditure in respect of himself. So here I am not considering a person but individual. That means if I am calculating an individual's income tax liability, this is very important. So if an individual incurs some expenditure in respect of himself, so that kind of expenses are not allowable as a deduction. The expenditure shall be domestic expenditure to the extent that it is incurred in maintaining the including in providing shelter as well as meals, refreshment, entertainment or other leisure activities. So what is that, the meaning of that? That means if I am an individual and I am doing a business, so when I am calculating a taxable profit of that of my business, then the expenditure incurred in respect of myself cannot be deducted. So what are the expenditure that I can incur in respect of myself? My shelter, my meals, my refreshment, my entertainment, my other leisure activities. If that expenses are incurred in respect of myself, it is not deductible. The next one is individual commuting from home. That means traveling expenses from home to other places. So that expenses are not allowable as a deduction. Then in acquiring clothing including shoes for the individual other than clothing that is not suitable for wearing outside of work. It is very important. That wordings are very important. It says clothings including shoes are not allowable. So what are the expenditure I can incur in respect of myself? Expenditure for my shelter, my home and all my things in my home. Then my meal, entertainment, refreshment, everything. My traveling expenses, because that is also incurred for myself. Then for my clothing, including shoes. But some expenditure incurred for clothing are allowable as a deduction. What kind of clothing? Which is not suitable for wearing outside of work. Not suitable for wearing outside of work. Who can tell me what kind of clothing is it? What kind of clothing? In one word, who can tell me? Safety clothes, yes. Safety clothes, uniforms. Yes, mainly safety clothes. We cannot wear it outside. Uniforms also, okay. But there are some uniforms that we can wear outside. For an example, we can see some ladies are wearing a sari. Can we wear it for outside of work? Yes, we can see they are wearing it for outside of work. That means after their work, they are going home with that sari. So even though that is a uniform, we cannot allow that kind of uniforms as an allowable expenditure, because this specific clause is here. Other than clothing that is not suitable for wearing outside of work. So that means for every Friday in bank sector, in public sector, they are wearing a t-shirt and a trouser. So it is also a kind of a uniform, but it is not allowable as a deduction. Why? It is suitable for wearing outside of work. But safety clothes, shoes, those are not suitable for wearing outside. So therefore that kind of uniforms are allowable as a deduction. Then the next one, in educating the individual other than education that is directly relevant to a business conducted by the individual and that does not lead to a degree or diploma. That means educational expenses also incurred in respect of that person, for myself, for yourself, that is also not allowable as a deduction. But if that education is directly relevant to a business conducted by the individual, so if it is directly relevant to the business but it should not lead to a degree or diploma, so that kind of educational expenses are not allowable as a deduction. But that education is directly relevant to that person, to the business, then that expenditure is allowable as a deduction. The next one, in paying any personal debts including credit card, debit card of the individual. So credit card, debit card expenses also not allowable as a deduction. So under subsection 1, I am saying expenses incurred in respect of himself. So that kind of expenses are not allowable as a deduction. Then subsection 2, it says where another person incurs expenditure in making a payment to or providing any other benefit for an individual. That means I am not incurring that expenditure, but another person incurred expenditure in making payment to or providing any other benefit for an individual. That means on behalf of me, the other person incurs that expenditure. The expenditure shall be domestic expenditure except to the extent. So if that kind of if the expenditure is like this provided under item A, B, C, that kind of expenses will be considered as domestic. So that is why it says the expenditure shall be domestic expenditure except to the extent other than these things. That means, the payment or benefit shall be included in calculating the income of the individual. So what is the meaning of that? That means, for an example, as an employer, I pay some amount to my individual. If that individual, the individual means that employee, individual means not the person, individual means a person like me. So if employer makes some payment to that individual means to employee, and if that employee included that amount when calculating that individual's income tax, then the employer can deduct that expenditure. Otherwise, he cannot deduct that expenditure. Then we consider that expenditure as a domestic expenditure. The next one says, the individual provides consideration of an equal market value for the payment or benefit. That means, if we are giving something to an individual, so that individual provides consideration of an equal market value. That means market value of that benefit will be given to the employer or any other person. Then that person can deduct it as a deductible expenditure. Otherwise, the person cannot deduct it. Here we are using the person, not the individual, where another person incurred. Person can be either an entity, company or partnership. Anything can be this person. This person make the payment to an individual. So if that individual included that amount under his income, when he is calculating his income tax liability, then this person is allowable to deduct it as an expenditure. This person's expenditure individual's income. So it has two phases. Under this payment person, it is an expenditure. In the hands of the individual, it is an income. The next one says, if this individual pays market value to this person, then only this person can deduct it as a deduction. Under item C, the amount of the expenditure is so small to make it unreasonable or administratively impracticable to account for it. So I think you can remember, when we are considering an employee's benefits, when we are calculating employment income, under employees' benefits, when we have excluded this kind of unreasonable and impracticable amounts. So I have given you an example like tea. In the organization, the employer provides tea, some snacks to their employees. So it is very difficult to ascertain that specific employee's benefit because it is not reasonable. The next example I was given is a traveling, group transport. So it is very difficult to ascertain. So that is why we are saying it like this. The amount of the expenditure is so small as to make it unreasonable or administratively impracticable to account for it. Then this person is entitled to deduct it as a deduction. The third one is expenditure incurred in subsection 1 and 2 shall include interest incurred with respect to money borrowed that is used in the manner referred to in those subsections. That means I have mentioned subsection 1. It says in expenditure incurred in respect of himself. Then subsection 2 says expenditure incurred by another person in respect of this individual. Then under item 3 it says expenditure referred to in subsection 1 and 2 shall include interest incurred with respect to money borrowed that is used in a manner referred to in those subsections. That means for an example, as an employer, if I don't have money to give to make expenses, what I am doing? I am borrowing money, and for that borrowed money I have to pay interest. So if that borrowed money is used for this type of expenditure, then the interest also not allowable as a deduction. So not only the expenditure, the borrowed money, if we use that borrowed money to incur expenditure mentioned under item 1 and subsection 1 and subsection 2, so that interest expenses also not allowable as a deduction. So those are the expenses that are not allowable as a deduction under domestic expenditure. So I will show you it in the act. So if you have questions under subsection 1, under section 10, you can ask now. So I have given in my slides in a summary form, so you can see these expenses in the act like this. So subsection 1 A, B, then I have explained about domestic expenses, then all other expenses given under 10(1)(b). up to subsection 4, you can see the not allowable deductions under subsection 10. So I think now you can understand, and now you can read that now you can read that also, so you know how it has available in the Act. So for the domestic expenses, we have a specific definition under section 195. Okay, this is section 195. Under this section 195, you can see definitions for dividend, then entertainment. So here you can see the definition for dividends. It is not just a dividend, but it includes lot of things. So share buyback also a type of a dividend. Here entertainment means the provision to any person of food, beverage, tobacco, accommodation, amusement, recreation, or hospitality of any kind. So this is prior to 2021. So after that we made some amendment to that one. So it is like this, means the provision to any person of liquor, tobacco, accommodation, amusement, recreation, or hospitality of any other kind. So it is earlier it has another one like this. Here food, beverage, tobacco, food and beverage also included here, but we removed food and beverage from the entertainment because entertainment expenses means it is not allowable as a deduction. So I think you can remember, it is not allowable as a deduction. So liquor and tobacco included, substituted for that food and beverage. So now it is liquor and tobacco, accommodation, amusement, recreation, or hospitality of any kind. So this kind of expenses we call entertainment expenses. So that is also not allowable as a deduction. Then we can move to section 197, because it is the domestic expenses are provided in section 100. One person asked about the difference between person and individual. So here you can see person means an individual or entity. That means person also included, individual also included under person. So that means individual or entity all together will be a person. So person is just not only one individual, but individual plus entity. Entity means company and partnership also included. Section 197, 6. So section 196 is for the associate persons. So if we in our employment income, when we are considering employment income, we discussed about associates. So for the term associated person, you have a specific definition. Then section 197, we call it domestic expenditure. So it has subcategory, sub-item. Section 197, subsection 1, it says expenditure incurred in respect of himself. Then subsection 2 says another person incurs expenditure in respect of an individual. Then subsection 3 says if we borrowed money for incurring that expenditure mentioned under subsection 1 and 2, and if we pay some interest amount for that borrowed money, that is also not allowable as a deduction. We consider it as a domestic expenditure. So if you have questions now, you can ask. Up to now I have explained the expenses that are not allowable as a deduction when we are calculating business income or investment income. Then we can move to the next sets of slides. So prior to that, you can ask questions if you have. Is it clear to all of you, or still you have some issues? Okay. That means you don't have questions. Is it clear what we are doing? Clear, or you cannot understand, or you what is the what is your position? Please let me know. If it is very clear or not clear, I need your feedback. So is it clear?
Yes, madam.
Okay. Okay, then we can move. Then we are moving to section 11. That means section 10 is for not allowable deductions, but section 11 is completely different thing. So that means in calculating a person's income from a business or investment, so this is also applicable for both two sources. For a year of assessment, expenses to the extent they are incurred during the year. That means if that expenditure is incurred during that year of assessment by that person, not the individual. So you know that it is applicable to both individuals and to companies. So these deduction rules are applicable not only to individuals but to companies. So entity means company and partnership. So all institutions, taxable institutions, these deduction rules are applicable. So it says when we are calculating business or investment source for a year of assessment, the expenses incurred to the extent during that year of assessment in the production of income. This term is very important. In the production of income. If we have incurred some expenditure in the production of income from business or in the production of income from investment, that expenditure is deductible. But subject to section 10, if that expenditure is specifically mentioned under section 10 as it is not deductible, even though it is incurred in the production of income, we cannot deduct it as it is not allowable as a deduct for that year of assessment. So section 10 is very important. If an expenditure is not allowable as a deduction under section 10, then we cannot deduct it under section 11. So when we are deducting expenditure, first of all we have to consider whether it is deductible under section 10 or not. If it is deductible, then only we have to consider whether that expenditure is incurred in the production of income for that specific year of assessment. If so, that is deductible. But there's a clause but. It says no deduction shall be allowed for the expense of capital nature. If it is in capital nature expenditure, if it is for a capital nature asset, that expenditure is not allowable. So what is the definition for the capital nature? What is the meaning of capital nature? Expense of a capital nature includes an expense that secures a benefit capable of lasting longer than 12 months. That means if the benefit of that expenditure has 12 months period or 12 months period, that means we consider that expenditure as a capital nature. So what are the expenditure that we can consider as a capital nature expenditure? What kind of expenditure? Expenditure we incur to purchase some fixed assets, machinery, then what else? Expenditure for the building. So that means expenditure incurred for the purchase of fixed assets, we can call that is a capital nature. So that kind of expenses cannot be deducted under section 11, but all other expenses, if that expenditure is incurred in the production of income of business or investment, it is deductible. So I think now you can understand the difference between section 10 and section 11. Is it okay? Okay. So now you know what is the difference between section 10 and 11. Then we can move to the specific deduction rules. So those deduction rules are starting from section 12 up to section 19. So these are also very important because even though all expenses are deductible under section 11, if some specific expenditure has a specific deduction rule mentioned under section 12 to section 19, we have to deduct that expenditure under these specific deduction rules, not under section 11. For an example, here I have mentioned expenditure incurred in interest expenses. Interest expenses means after we obtaining a loan, borrowing a loan from a bank for the purpose of our business to incur expenditure for the business purpose, we can borrow money. For the payment of for that borrowed money, we have to pay interest. So we can consider that interest as an expenditure incurred in the production of income from business. But since we have a specific deduction rule for the interest, we cannot deduct interest expenditure under section 11. The next example, under third one, repair and improvements. So there is a specific deduction rule for repair and improvement. Suppose we have made some repair, we have incurred some expenditure for repair, our machinery, our furniture and fittings, so in our building. So we can think that that expenditure was incurred in the production of income. Therefore, we can deduct that expenditure under section 11. Yes, you can deduct, but since we have a specific deduction rule, we have to go to that specific deduction rule to be deducted that kind of specific deductions, because for that specific expenditure we have a specific deduction rule. Therefore, since we have a specific deduction rule under section 14, we cannot deduct that expenditure under section 11. The next important thing is, under section 11, we cannot deduct capital nature expenditure. But from section 12 to section 18, we can deduct capital nature expenses also, but subject to some limitations, not the total amount, but subject to some limitations. Therefore, deduction under specific deduction rule is very important because it has more benefits than section 11. So I think you can understand. If you have questions, you can ask. Because now I am going to move to the next slide set. So prior to that, if you have some issues from this one, you can ask. So this is just a summary. So I have mentioned section 12 to 19 are specific deduction rules. So even though those deduction rules are applicable both to business and investment sources, some specific deduction rules are applicable only to business. Some specific deduction rules are not applicable to investment source. So that is why I have given you this table. So section 12 is for the interest deduction. Interest deduction, it is applicable both to business income and investment income. Section 13 is for the trading stock deduction. It is applicable only to business income because trading stock is available only for the business. It is not applicable for the investment. Then section 14 is for repair and improvements. It is also applicable for business income. Section 15 is research and development and agricultural startup business. So it is also applicable for business income. Section 15A. So now you can, I think you can remember, we have included this section from 2021 amendment. So that is why we have included it in between section 15 and 16. Then we named it as section 15 capital A. So it is marketing and communication expenditure. It is also for the business. Then under section 16, capital allowances are provided. That is also for business income. Then section 17 applicable for the losses on realization of business assets. So last week I explained what are the business assets, what are the capital assets, what are the investment assets. So this is for the business asset and liabilities. It is also for business income. Then section 18 is for the deductible amount of financial cost. Interest also a type of the financial cost. It is under section 12. Section 18 is also for the deductible amount of financial cost. So under section 12, we have given a specific deduction rule for the interest. But under section 18, specific limitation is provided for the companies, only to companies under section 18. So section 12 is mainly applicable to individuals, but under section 18 the application of this interest rate is limited by section 18 under for the companies. Then section 19 is for the business and investment losses. That is applicable both to business and investment. Financial cost also for the business and investment. So when we are calculating business income source, we can deduct this kind of expenses subject to some limitations, some specifications provided under these provisions. In addition to that, when we are calculating investments or income source, we can deduct some expenses, some specific provisions under section 12, section 18 and section 19. So these are available for business income and investment income. So this is just a summary. Then we can move to the specific deduction rules. One by one deduction rules should be studied. So now we can move to that deduction rule sets 2. So if you have questions, you can ask. ප්‍රශ්න තියෙනවා නම් සිංහලෙන් උනත් කමන්නේ ඇහුවට. Do you need a break? Students, do you need a break? Shashikala need a break. Only Shashikala? No. Achala. Mayura. Okay, you will have a 10 minutes break. By 8:30 we can start. Okay, we can start now. So our first specific deduction rule is section 12, that is interest expenses. So when we are deducting interest expenses, that means if we can find interest expenses deducted by some organization when they are calculating their profit, then we have to apply section 12 to find out whether that interest expenditure is allowable to the deduction or not. So it says, for the purpose of section 11, the interest incurred under debt obligation shall be deemed to be incurred in the production of income to the extent. Deemed to be incurred in the production of income to the extent. That means if we consider this expenditure, if they incurred the money borrowed under such debt obligation was used to acquire an asset. That means they can borrow money and that borrowed money should be used to acquire an asset that is used during the year in the production of income. That means if that is an interest expenditure, so we have to think for the purpose of borrowing that debt. Debt obligation means we borrowed money from an institution, from a bank. So we have to consider the purpose of that borrowing money. So if we can borrow money and that borrowed money can be used to acquire an asset. And if that asset is used during that year in the production of income, then the interest paid on that borrowed money can be deducted under section 11, even though that asset is a capital nature asset. We can deduct interest expenditure. The next one is, in the case of that debt obligation was incurred in the production of income. That means we can borrow money and that borrowed money can be incurred in the production of income. That means for our working capital, if our working capital deficiency is there, then we can borrow money from a bank. So either we can use that borrowed money in the production of income, or we can purchase an asset, and if that asset is used during that year of assessment in the production of income, then the interest paid on that borrowed money is deductible. But for this purpose, we have a specific restriction for the companies, but for the individuals, the total amount can be deducted without any restriction. So if there is a if we are considering about a company, that means when we are calculating an individual's tax liability, without any limitation, total interest income can be deducted. But if we are calculating a company's tax liability, then we have to apply the restrictions under section 18. So that the section 18 amount can be deducted. Okay. So there is an example. This is an example. It says Mrs. Sanjeevani runs a beauty salon with a spa. So in 2025-26 she borrows funds from bank A. Same year of assessment, so she borrowed money from a bank, and she used that borrowed money for the following purposes. She purchased a special equipment for her spa, and the next one, she also uses some of the funds to pay the rent on the premises she runs a salon. Then the remainder of the funds she uses to pay her child's admission fee for school, and she paid interest on the loan. So what part of interest can be deducted under section 11? Because she borrowed money from a bank, she used that borrowed money for several purposes, not for the business purpose but for the several purposes. So we have to consider whether that borrowed money used for the purpose of the business, or if she purchased an asset, whether she used that asset during that period, or whether she used that borrowed fund for her personal purposes. Then we can apportion the interest part into the each purpose, and the business purpose expenditure can be allowed as a deduction. Personal parts cannot be allowed as a deduction. Okay, we can go to the answer. The equipment she purchased for the spa is for her business, so we can allow it as a deduction. Even though it is allowed under section 11, we cannot deduct it under 11 because specific section is available, that is section 12. So under section 12 she can deduct that expenditure. So rent on premises, that funds also used for the payment of the rent of her business place. Therefore it is deductible under section 12. That means she used that borrowed fund for the business purpose, payment of the rent and to purchase an asset. So both amounts can be deducted as a proportionate amount can be deducted under section 12. But the balance part she used to pay her child's admission fee of school. So that is a personal used one. Therefore it is not deductible. So proportionately we can disallow that part. That means we cannot allow that portion as a deduction. Suppose we sold this asset during that year of assessment. What is the practical solution for that? If she sold that asset, so can she still deduct borrowed interest on that borrowed money? That means now in the provision it says either she can use that money for the business purpose, or she can purchase an asset, and if she used that asset in the production of income, then of course she can deduct that borrowed interest on borrowed money. Suppose that asset was sold during the year of assessment. So what do you think? Can this Mrs. Sanjeevani still deduct interest portion or not? What is your answer? Because that kind of practical situations may be there. So if she sold that asset during that period, but we know even though the asset is sold, she has borrowed money, so she has to pay that borrowed money back. Until then she has to pay interest. So each and every year she has to pay interest even though she has already sold that asset. So what do you think? after selling her asset, can she deduct this amount, the proportionate amount? Can she deduct the proportionate amount or not? No. Two answers are there. They said no. Why? Why not? Yes, you said no. It is a conditional. So, it is based on the facts. That means, after selling that asset, if she used that consideration for the business purpose, then no issue. She can still deduct interest portion. Why? Because two conditions are there in section 12. One is she can borrow money and that borrowed money can be used in the production of income, or she can purchase an asset and that asset should be used in the production of income. If she sold that asset during the period and the considerations she received after selling that asset, if she used that consideration for the business purpose, then again that the second condition was already fulfilled. Therefore, no issue. She can still deduct this interest. But if she used that consideration for the personal use, then only she cannot deduct that interest portion, since that is not incurred in the production of income. So it depends on the facts of the case. So we have to consider what has happened to the consideration after selling this asset. Okay, now we have finished section 12. Now we are in section 13. So it says allowance for trading stock. So what is the meaning of trading stock? I have already given a definition for the trading stock. I think you can remember. If you have previous slides with you, you can refer it. Trading stock means assets owned by a person that are sold or intended to be sold in the ordinary course of a business. That means in the business sector, if that business is selling some goods and goods, not the services, but goods, that means that business has a trading stock. That means stocks to be sold or intended to be sold in the ordinary course. So we call it trading stock. We can purchase some stocks to be sold. We can manufacture some goods to be sold. So both are trading stock. So now we are going to give allowance for trading stock as a deduction under section 13. So why do we give a deduction for the trading stock? There is a specific reason. What is that reason? I think you can remember when we are identifying items that should be included for the business income under subsection 2. The first one is service fee. The second one is consideration received in respect of a trading stock. That means at that time we considered the total amount we received by selling that trading stock, not the profit. That means for the calculation of business income, assessable income from business, we have to consider the profit. If we are considering the total consideration received for that trading stock, then definitely there should be a deduction for the purchased value. That means for the cost. If you have studied for commerce subjects or accounts for your A levels or for the first degree, then you know what is trading stock. You know what should be deducted to be calculated the gross profit from the turnover consideration. So, for the calculation of gross profit, we should have two items. One is turnover or consideration received in respect of trading stock. Then from that amount, we have to deduct cost or cost of sales. Turnover minus cost of sales equals gross profit. So, since for the taxation, we have considered consideration received in respect of the trading stock, that means we considered only the turnover. So, for the calculation of gross profit, it is equals to the assessable income of business. We should have deducted the cost of sales. So, in the taxation, we call it allowance for trading stock. That means cost of sales is very similar or equal to the allowance for trading stock. So, that is why we have given a specific deduction rule to be deducted cost of sales. For the tax purpose, we call it allowance for trading stock. So, how do we calculate it? Allowance for trading stock means equals opening stock plus purchases minus closing stock. So, based on this formula, we can calculate cost of sales or allowance for trading stock. So, to the deduction of this cost of sales, we need a legal requirement. Legal application, legal approval is required. So, that is why it is given under section 13. So, now we can deduct cost of sales or allowance for trading stock under section 13. It is calculated very similar to the cost of sales. So, opening stock plus purchases during the year of assessment minus closing stock. So, the closing value of the trading stock of a business for a year of assessment shall be the lower of. So, this is also similar to the accounting standards. It says closing value of the trading stock should be calculated according to the given formula. So, it is value of stock equals cost or market value, whichever is lower. So, we should consider the cost or the market value of the trading stock at the end of the year of assessment. So, whichever is the lower should be considered as a value of stock. Why do we consider lower one? We can consider the higher one. No, we cannot do it. We are considering the lower one because it is a closing value. If we considered higher value, that means our cost of sales value will be very high. If we consider higher value, then what will happen? If it is higher value, then the allowance for trading stock. What happened to the allowance for trading stock? Normally, allowance for trading stock is higher than higher value means the lower profit. If allowance for trading stock is the smaller value, then there will be a smaller value, means there will be a low profit. So in the taxation they want to calculate the lower cost. Therefore we have given a specific definition to be calculated. So lower value should be considered as a closing stock. So this is the allowance for trading stock. Okay, now we can move to the repair and improvement deduction. So it is a next deduction rule. That rule is applicable for the repair and improvements, that is under section 14. So section 14 explains how and to which extent and how we have to apply this provision. So section 14 is applicable to the expenses for the repair or improvement of depreciable assets. So you know what are the depreciable assets. Depreciable assets means an assets we used in the business purposes. So we are using that assets in the business purposes and there should be a diminishing value. So we are using lands for the business purposes but it is not diminishing. Therefore we cannot consider it as a depreciable asset. So all other assets that we are using for the business purposes can be considered as a depreciable asset. So if for a depreciable asset, if we have incurred an expenditure for a depreciable asset as repair and improvement, then we have to apply section 14. But the repair or improvement expenditure either can be a capital nature asset or a revenue nature asset. Without considering whether that is capital nature or revenue nature, we can deduct total expenditure. So I think you can remember under section 11 I explained that expenditure can be deducted if that expenditure are incurred in the production of income, but capital nature was not allowable under section 11. But under section 12 or section 14, we can deduct capital nature expenses also. That is why it says shall be deducted irrespective of whether they are of capital nature or not. So even though that repair and improvement expenditure is a capital nature, irrespective of whether that is, we can deduct that expenditure. So under section 11 restricts capital nature expenditure. Section 14 permits capital nature repair and improvements. So that is the difference between section 11 and section 14. So as I explained earlier, if we use that asset for the business purposes and if we have made some repair or improvement expenditure, then we can consider that expenditure was incurred in the production of income. Therefore, we can apply section 11 for that. No, we cannot say it because we have a specific deduction rule for repair and improvements. Therefore, most specific deduction rule should be applied for the deduction of that kind of expenditure. So what is the importance? Why this kind of deductions? What is the benefit of deducting repair and improvements under section 14? If that expenditure is a capital nature expenditure, it is deductible under section 14, but if it is not deductible under section 11. So that is why we have two reasons. If it is a specific reason, if it is a repair and improvement, or if it is deductible under specific deduction rule, then we have to apply specific deduction rule. In addition to that, capital nature expenditure can be deducted. So these two benefits are available if we are going to deduct it under specific deduction rule. So for this section 14, we have made some very small amendment. So after that, with that amendment, this is applicable for the year of assessment from 21 to 22. Therefore, it is applicable to the year of assessment 25 to 26 also, which is relevant for your examination. So it says like this: the deductions of improvement. So in the act it says deduction of repair and improvement, but it was amended, repair part removed. So if that deduction is for the improvement, then we can deduct that expenditure subject to the conditions given under this part. That means subsection 1 says repair and improvement expenditure is incurred in the depreciable asset, then irrespective of whether they are capital nature or not, can be deducted under subsection 1. But subsection 2 says if that expenditure is incurred for the improvement, then there is a limitation. That means if that expenditure is for the repair without any limitation, total repair expenditure can be deducted. If that expenditure is for the improvement, then that improvement expenditure can be deducted subject to the restriction given under subsection 2 can be deducted. So what is that deduction condition? That deduction, that expenditure shall not exceed, that means improvement expenditure shall not exceed, in the case of improvement to a class 4 depreciable asset, 5% of the written down value of the asset at the end of the previous year. In all other cases, 20% of the written down value of the asset at the end of the previous year shall be allowed in the order in which the expenses are incurred. So this is the provision given under section 14. So when we are deducting expenses, we have to consider this one. If there is an excess expense, that expenditure shall be added to the depreciation basis. So there are a lot of conditions. It is very difficult to understand what am I talking. So I know that it is very difficult. Therefore, I am going to do this explanation with an example. So what you have to keep in your mind, we can make expenditure for repair and improvement if that repair and improvement is incurred in the depreciable asset. Section 14 is applicable. If it is for the repair expenditure without any restriction, total expenditure can be deducted. If that expenditure is for the improvement with the specific condition, that amount can be deducted. If there is a balance that cannot be deducted, that amount should be added to the depreciation basis. So those are the conditions. So when we are restricting improvement expenditure, we have to consider to what kind of asset we have made that improvement. So we have classified assets into 6 classes. So if that improvement is made for the asset classified under class 4, then 5% is the applicable value. In all other cases, 20% is the applicable value. So we will calculate that 20% out of the written down value, from the written down value of the asset. So how do we do these things? So what is the class 4 asset? So in the Act, under Schedule 4, I have mentioned it, paragraph 4.3 of the 4th schedule. In the 4th schedule of the Act, we have a depreciable assets table is there. Depreciable assets table is there. In that depreciable assets table, assets are classified into 6 classes. So if that asset is under class 4, so under class 4 asset means a building is classified under class 4. Then if that repair or improvement is done for the building, then the value should be multiplied by 5% to be calculated the allowable value. Other than class 4 means all other assets. It can be a vehicle, it can be a furniture and fitting, it can be a machinery, it can be a computer, it can be anything, any depreciable asset. So then we have to multiply it by 20%. 20% to be calculated the allowable value. That means 20% of what? 20% of the written down value of the asset. For an example, if we have purchased a machinery during the year of assessment 21-22, so written down value means 21-20. If we purchase that asset in 21-22, from 21-22 to 21-23, 24-25, 26. Now we are in 25-26. Now means when your examination we are calculating tax liability for 25-26 year of assessment. So up to that year of assessment, we have used that machine for 4 years. That means each and every year that value is depreciating. So after depreciation of 4 years, we have a written down value. Written down value means the value of the asset at that time. So each and every year when we are using that asset, it is depreciating. So written down value means the value of the asset at that time. So we will multiply that value, that means written down value, by 20% or 5%. So after that, we have included one more amendment to this section 14. We call it section 14.4. So sometimes after we deducting depreciation each and every year, then there will be zero written down value. Zero written down value means for the assets we have given only 5 years lifetime. That means if it is a machinery, we believe that within 5 years period the written down value will be 0. After 5 years period, written down value will be 0, because each and every year we are depreciating for the first year, second year, third year, fourth year, fifth year. After fifth year, after deducting capital allowances, our written down value will be 0. So if we are multiplying that 0 value from 20% to 5%, what is the answer? Answer will be 0. answer also will be 0. That means after depreciable period also we can incur some expenses for repair and improvement. If the written down value is 0, even though we incurred some expenditure for repair and improvement, since that value is 0, we cannot deduct even 1 rupee. So it will be an issue for the businessman. Therefore, if after 0, after written down value becoming 0 also, we know that there will be some expenditure for repair and improvement. Therefore, to be considered that kind of expenditure, we have included this subsection 4 to section 14. So it says 12 years of assessment for a class 4 depreciable asset. That means after incurring expenditure for the assets that have 0 written down value, then if that expenditure was incurred for the class 4 depreciable asset, the improvement amount should be divided by 12 years, and each year 1/12 value can be deducted as a improvement expenditure. That is for class 4 asset. If it is other than class 4 asset, the expenditure value can be given only 1/3 of the amount incurred. So this is a specific insertion from the Amendment Act. So for the term improvement, we have given a definition because it is very difficult to draw a line in between repair and improvement, because if that expenditure is for the repair, without any limitation, total repair incurred value will be allowed as a deduction. Only restriction is applicable only to the improvement cost. Therefore, we should have a better understanding about what is the income we can consider as repair and what are the expenditure we can consider as improvement. It is very difficult to draw a line in between repair expenditure and improvement expenditure. Therefore, we have given a specific definition for the improvement cost. It says improvement means the expenditure incurred by a person to make additions or alterations to a depreciable asset, which enhances the value of such asset. That means day-to-day repair, running repairs are not considered as an improvement cost. It is just a repair expenditure. So temporary enhances the value also not considered as the improvement. It is just a repair expenditure. But if after making some improvement cost, definitely there should be enhances of the value of such asset. Value of the asset should be enhanced after making some improvement cost. So if we can identify that kind of enhances, then we can consider that expenditure as improvement and all other expenses as a repair. So what do you prefer? If you have an expenditure for repair and improvement, under which category you like to categorize it? Under repair or under improvement? Under which category you try to categorize? You try to deduct it under repair or improvement? Repair. Oh, yes, repair. Why? Without any restriction, we can deduct it. So that is why we have given a specific definition for the repair, for the improvement. Then all other expenses can be categorized under repair and total amount can be deducted. Okay. Then you didn't receive today's attendance. So what I can do? Shall I ask Kalhari? Okay, she will upload the attendance. Okay, so this is an example. This is an example for the repair and improvement deduction. Company, this is for a company. It doesn't matter whether it is for a company or a individual's business. This is applicable for both. So I have given you a company. So company R runs a manufacturing business. During the following years of assessment, it incurs expenditure as follows. So the company purchased an asset during the year of assessment 18-19. Then 21-22, they incurred expenditure for repair to the machine. Then improvement to the machine 2.4. That means two expenses were there, two categories, repair expenses and improvement expenses. Then 22-23, maintenance expenses of the machine. 23-24, improvements to the machine. 24-25, improvements to the machine. Since the machine is under class 3, the deduction for improvement is limited to 20% of the depreciable basis of the machine at the end of the previous year of assessment. So since this is a machine, we know under class 4, if it is under class 4, that means it should be a building, because class business assets are classified under class 4. This is not a business, this is not a asset classified under class 4 but class 3. So applicable limited percentage is 20%. So now we have to categorize whether those expenditure are improvement or not. Let's move to the answer. So please write down these amounts, then we can insert that amounts in the answer sheet. Yes, I have done this, I have calculated it like this. I have applied this table. So 1889, they purchased this asset for 20 million. So capital allowances, actually it is better if we could do this section 14 after section 16, but I will explain this again after I explain section 16, because section 16 says how to calculate capital allowances. So capital allowances means the depreciated amount during that year of assessment. So if we purchased an asset in the year of assessment 18-19, if we have used that asset during that year of assessment, we can give capital allowance. So the period is 5 years. If it is an asset categorized under class 4, depreciable period is 20 years. If we categorize that asset other than class 4, all other classes depreciable period is 5 years. So that is why I have divided this 20 million by 5 to calculate 18-19 depreciated value. So since I have purchased this asset during the year 18-19, capital allowance for that asset for that period is 4 million, because for the purchased year, if we use that asset, we can grant capital allowances. If we have not used during that purchased year, we cannot grant capital allowance. Therefore, we assume that they used that asset during the year of assessment it purchased. So that is why I have granted capital allowance. So after granting 4,000 capital allowance, what is the written down value of that asset? Written down value means cost minus capital allowance. Cost 20,000 minus capital allowance 4,000. Balance is 16,000. That is the written down value at the end of the year of assessment of this asset. Now we are moving to the next year of assessment, that is 19-20. Then what is the 19-20 open written down value? Beginning written down value. That is the value we have considered for the end value. That is the beginning value. So that is 16 million. So again for the year of assessment 19-20, we can grant capital allowance by dividing it by 4, because we have 5 years period. So 18-19 is the fifth one, 19-20 is the 4th year. So we can divide it by 4 to calculate the capital allowance. Then we have the written down value. So that is 12 million. Then we can move to the year of assessment 2021. Again we have to calculate capital allowance to be calculated the written down value. Why do we need that written down value? Because in the formula it says to be considered the restricted amount, we have to apply 5% or 20% to the previous written down value. So up to that date, up to that year of assessment, we have to calculate previous written down value. So during the year of assessment 21-22, they incurred expenditure for repair and improvement. So for the restriction of that amount, repair improvement value, we should have previous year written down value. That is why we calculated it up to 2021 period. Then what is the beginning written down value? That is 8 million. So that 8 million can be divided by 2 to calculate the capital allowance for 21-22, that is 4 million. Then there is a repair value and the improvement value. So repair value is 500,000, improvement value is 2.4 million. So repair amount, full amount can be allowed as a deduction, but the improvement value should be limited to 20%. 20% from which one? That is from 8 million. So 8 million into 20% is 1.6 million. So what is the amount we can allow as a deduction? That is 1.6 million. So what is the incurred value is 2.4 million, because repair total amount can be allowed as a deduction, no issue. But improvement, the company has incurred 2.4 million but can be allowed only 1.6 million. Then the balance 800,000 is not allowed as a deduction. What we have to do? That not allowed amount should be added to the current year written down value. So what is the current year written down value? That is 4 million, because we have only 4 million. So to the current year written down value is 4 million. To that 4 million we have to add that not allowed improvement cost. Then what is the beginning written down value? It is not only the written down value of the previous year, but the not allowed amount also should be included here. Then the value is 4.8 million. Then we have only 1 year to be deducted capital allowances, that is 4.8 million. So that is the written down value, 4.8 million. 4.8 million divided by 1, 4.8 million is the capital allowance for the year of assessment 22-23. Then what is the written down value for that year? Zero. So written down value is 0 for the year of assessment 22-23 period. Then we have to consider the repair amount, that is 370. Total repair amount can be allowed as a deduction, no restriction. Then the written down value at the end of the previous year is 0. Now then we have an issue. Since the written down value is 0, we cannot multiply it by 20% to be calculated the allowable value. So improvement cost 3 million was incurred during the 23-24 year of assessment, that is 3 million. So since the previous year written down value is 0, we cannot calculate allowable amount by multiplying it 20%. What is the value? If we multiply 0 value into 20%, it will be 0. If it will be a 0, that means if we apply 0 value, then no any amount can be allowed as a deduction. That is why we have amended that to be allowed some amount of the as a deduction. So what we have done, if we incur 3 million, since it is a class 3 asset or since it is other than class 4 asset, we can divide this 3 million by 3 to calculate 1/3 of the value. So 1 million can be allowed as a deduction. Another 2 million can be carried forward. So carry forward, it can be carried forward. So in the next year also again we have a improvement expenditure. 1/3 of the amount can be allowed as a deduction. So 1/3 plus the previous period. So all can be carried forward. So this is the calculation. So if you have up to now you have the question, try to calculate, try to memorize, try to calculate. If you have questions, you can ask from this example. ඕකේ 21 22 කොටස ටිකක් සිංහලෙන් කියන්න පුළුවන්ද? හරි. 21 22 කොටස කියන්නේ section 14 වල කියනවා repair තියෙනවා නම් කීයක්වත් අඩු කරන්නේ නැතුව මුළු ගානම ඉඩ දෙන්න පුළුවන්. අඩු කරන්නේ නැතුව කියන්නේ සීමාවක් නැතුව. එතකොට 21 22 දී මෙයා දරලා තියෙන වියදම තමයි පොඩ්ඩක් ඉන්න 21 22 දී මෙයා කරලා තියෙන්නේ මොකක්ද? 21 22 දී repair වලට ලක්ෂ 5ක් දරලා තියෙනවා. improvement වලට 2 ලක්ෂ මිලියන 2යි ලක්ෂ 4ක් දරලා තියෙනවා. ඒතර මේ දෙක අපි ඩිඩක්ට් කරන්න යන දැන් මේක කරන්නේ කවදාද? මේක කරන්නේ මේ දැන් නෙවෙයි. මේක ඒ 21 22 අවුරුද්දේ කරන්න ඇති. ඒතර දැන් අපි ඉන්නේ 24 25 අවුරුද්දේ. එතකොට අර පරණ ඒවා හදාගෙන ඉස්සරහට එන්න ඕනේ written down value බලන්න. ඒ නිසා තමයි මේක ගත්ත දවසේ ඉඳලා අපි මේ හදාගෙන යන්නේ. හරිද? එතකොට දැන් මෙතනදී මොකක්ද මේ කියන්නේ? අපිට කියනවා repair expenditure ලක්ෂ 5 කිසිම සීමාවක් බලන්න එපා මුළු ගානම අඩු කරන්න දෙන්න. හැබැයි improvement වලට දරනවා 2.4 මිලියන් මේක සීමා කරන්න. මේක සීමා කරන්නේ කොහොමද? previous year written down value එක මිලියන 8න් 120ක් ඉඩ දෙන්න. එතකොට අපි ඉඩ දෙන කොටස තමයි මේ හදලා තියෙන්නේ. ඉඩ දෙන කොටසදී මේ ලක්ෂ 5 repair හින්දා සීමාවක් නැතුව අඩු කරන්න ඉඩ දෙනවා. 2,40,000 මේ 2.4 මිලියන් කියන එක ලිමිට් කරනවා. ඒක ලිමිට් කරන්නේ කොහොමද? ෆෝමියුලා එකේ කියන්නේ previous year written down value එක මිලියන 8යි ඒකෙන් 120ක් ඉඩ දෙන්න. ඒතර මිලියන 8ට 120 1.6 මිලියන්. එතකොට ඔන්න 1.6 මිලියන් ඉඩ දෙන්න කිව්වට අපි දරලා තියෙනවා 2.4 මිලියන්. එහෙනම් 2.4 මිලියන් දරුවට 2.4 මිලියන් ඉඩ දෙන්නේ ඉඩ දෙන්නේ 1.6 මිලියන් විතරයි. එහෙනම් ඉතුරු ලක්ෂයට මොකද කරන්නේ? ඉඩ නොදෙන වියදමක් විදියට අපි සලකනවා. ඉඩ දෙන්නේ නැහැ කිව්වට අපි සදාකාලිකව ඉඩ නොදෙනව නෙවෙයි. අපි කරන්නේ මොකද්ද? අදාළ වර්ෂයේ written down value එක බලනවා. මිලියන 8ක් තියෙනවා. මිලියන 8න් ඒ අවුරුද්දට දෙන්නේ ලක්ෂ මිලියන 4යි අඩු කරන්න දෙන්නේ. එහෙනම් තව මිලියන 4ක් ඉතුරු වෙනවනේ මෙතන. අන්න ඒක තමයි අදාළ වර්ෂයේ written down value එක වෙන්නේ. ඒ written down value එකට ඉඩ නොදුන්නු කොටස එකතු කරලා ඒ දෙකම අරගෙන යනවා 22 23 දී ආයිමත් සලකා බලන්න. එතකොට ඔයගලන්ට තේරෙනවා ඉඩ නොදෙන කොටස ඉඩ නොදෙනවාම නෙවෙයි ඒක වෙනත් ක්‍රමයකට එතනින් ඉස්සරහට ඉඩ දෙනවා. එතකොට ඉඩ නොදෙන කොටස බලන්නේ අලුත් වැඩි දියුණු කිරීම කියන ඉම්ප්‍රූව්මන්ට් කියන එකේ දරපු වියදමයි ඉඩ නොදෙන වියදමයි ඉඩ දෙන වියදමයි බලලා තමයි අපි සලකන්නේ ඉඩ නොදෙන කොටස. ඒක තේරුණාද? හරි good. ඊට පස්සේ madam how that capital allowance come 400,822 23 how this one you are asking about this one. So here this is the annual one, that means 2 million divided by 5 we will give 4,000 as a capital allowance. Then we have balance 16 million. Then for that 16 million divide by 4, then we are giving only 4 million as a capital allowance. Balance 12 million, that is the written down value. So for that 12 million we can divide it by 3. Then we will have 4 million as a capital allowance for the year of assessment 2021. The balance amount should be written down value, that is 8 million. 8 million will be divided by 2. Then we have only 4 million. That is the capital allowance for the year of assessment 21-22. If we deduct the year 21-22 capital allowances from the written down value, then written down value for the year 21-22 is 4 million. මොකද මේ 8,000න් 4,000 අඩු කරාම because this 4 million is the capital allowance for that year of assessment, but the written down value is 8 million. 8 million deducted by 4 million, the value is 4 million value, the balance value. Okay. You are asking about this one. So here the written down value for the year of assessment is 4 million. After 8 million minus 4 million, that is 4 million. Then not allowed amount is 800,000. That not allowed amount should be added to the written down value of the current year, not the previous year, but the current year written down value plus not allowed improvement cost, that is 800,000. Then we will have 4,800,000. Madam, why 1 million added to allowable for 24-25? 1 million added for why? Because during the year 23-24, we incurred 3 million. But since we don't have previous year written down value, since it is 0, we cannot apply 20% on that amount. Why? If we apply 20%, the value will be 0. That means again we cannot grant any amount as a deduction. So therefore, we amended the act according to that amendment, that we cannot apply that formula, this formula to the year of assessment 23-24, but we have given a new formula. New formula is 3 million. Out of this 3 million, only 1/3 can be deducted in the first year. That is why after applying 1/3 to 3 million, that is 1 million. Then 2 million is carried forward. But in the second period also, 1/3 can be given out of this 3 million. Then only 1 million can be carried forward for the improvement we incurred during the 23-24, and 500,000 incurred during the 24-25. Then we can carry forward that two amounts to the subsequent year. 1 million from 23-24, another 1 million from 24-25. That is why we have 2 million to be carried forward. In the 25-26 period, we can deduct balance 1 million from 23-24 and 500,000 from 24-25. Got it? Okay. What else? Other students, no issue? Clearly understood? What about other students? Repair and improvement calculation is clear to all of you, or still you have issues? Okay, I think it's clear. If you have any issue, you can ask. I think it is clear now because no questions from the students. We can move to the next slide. Then the next deduction rule is research and development expenses and agricultural startup expenses. That means if any person incurred expenditure for research and development or agricultural startup, that expenditure can be deducted under section 15. So for the research and development and agricultural startup expenses, specific definition is given in the same section, not in section 195. So it says research and development expenses and agricultural startup expenses meeting the requirements of subsection 1 of section 11 may be deducted irrespective of whether they are of a capital nature or not. So what is the meaning of meeting the requirement of subsection 1? That sentence is included in each and every specific deduction rule. It says that expenditure should be incurred in the production of income. So that expenditure should be incurred in the production of income. Only difference is under section 11 no capital allowances is allowed, but specific deductions, capital nature expenses also allowable as a deduction. Then what are the agricultural startup expenses? Means opening up any land for cultivation or for animal husbandry. Opening up any land means if we are doing an agricultural business, so even though we started it today, it takes long time for the cultivation. That means we have to clean the area, we have to plant, then we have to cultivate, then it takes long time for the harvest. But we have to incur some expenditure for that purpose. Therefore, specific expenses are allowed as a deduction because here it takes long time for the harvesting. Okay, then agricultural startup means opening up any land for cultivation or for animal husbandry. So that means agricultural means not only the plant, not only the cultivation, but animal husbandry also a part of that. Then cultivating land. First one is opening up a land, then cultivating land with plants. The purchase of livestock or poultry to be reared or land referred to in paragraph A. Maintaining tanks or ponds or the cleaning or preparation of any inland waters for the rearing of fish and the purchase of fish to be reared and in such tank, pond or inland waters. So that means not the fish in the sea, in the river, but the inland waters, specifically prepared a tank, pond or any place. So if we have fish within that specific place, then we call it agriculture. So that kind of startup expenses are allowed as a deduction. Then we can move to the research and development expenses. So for that research and development expenses also we have a specific definition. It is carrying on any scientific, industrial, agricultural or any other research for the upgrading of the person's business through any institution in Sri Lanka. That means there should be a research carried out by such person or through any, that means that person can carry it out by that research or any research institution in Sri Lanka carrying on any, can be in scientific, industrial or agricultural research. Through that research there should be an upgradation of the person's business. If there is no upgradation, then it is not applicable. There should be that research, through that research the business should be upgraded, and that research should be done by the same person or through any research institution. So expenditure incurred for that purpose is allowable deduction. The next one, the purpose of developing the person's business and improving business products or process. So improving business product or business process, then also it is allowable as a deduction. So earlier double deduction was allowable for the persons, but now it is not allowable for the year of, from the year of assessment 23-24. It is not allowable. Only one deduction is allowable. So that is research and development expenditure and agricultural startup expenditure. Okay. So that is section 15. Then we have to move to section 15A. But that section 15 has lot of things to be discussed. So not only the act but the Gazette notification also available for this purpose. Therefore, we can explain in the next day. But actually, these things available in the Gazette notification is not applicable for your year of assessment that you will have for the examination. Only the marketing and communication expenses are entitled, but for your understanding I will I will explain it in the next week. So if you have questions you can ask. I think 26th of June you have a midterm test. Therefore be ready for that midterm test. It will be on 26th June. So I want to tell you it because you should practice these things, mainly employment income. So after this session, after these two sessions, I will start investment income also. Then after we finishing our employment business and investment calculation of assessable income from employment business and investment, we can move to the calculation of taxable income. So be ready for the midterm examination. If you have questions you can ask now. Okay, we can stop the session now. So if you have questions, you can ask in the next week. You can ask. Practice section 14 because I have given you an example for section 14. You can practice it, and the employment income also. The examples I have given. It will be helpful for the midterm examination. If you don't have questions, we can stop the session. Then, good night to all of you.
Good night, madam. Thank you.
Okay, good night.